the laser pointer. No, I'm not sure that it's going to allow me to do the laser pointer. I'll do it manually. Anyway, you can see a very strong bear breakout here. And as strong as it was, it led to a reversal up. And here's the opposite. We gap up and we rally strongly on the open. And no matter how strong the breakout is, there's a 50% chance that instead of leading to a continuation up, you'll get a reversal down. Although you cannot see the bars to the left, these breakouts are always a test of support if it's a sell-off or a test of resistance on a rally. Strong sell-off became the low of the day, and strong rally became the high of the day. At the close of any bar of the day, you can get an idea of whether or not the high of the day or the low of the day has already formed. For example, by the close of the first bar of the day, there's a 20% chance that it will remain the low of the day. There's also a 20% chance that it will be the high of the day. Depending on context, sometimes the probability can be as high as 30%, but in general, there's a 20% chance that the first bar of the day will either be the low of the day or the high of the day. By bar 7, there is a 50% chance that this is going to remain the high of the day or this is going to remain the low of the day. By bar 12, the end of the first hour, there's a 70% chance that you've either seen the low of the day or the high of the day. And in this day, this was the high of the day. There are 81 bars in the day in the E-mini. Bar 80, the next to the last bar of the day, you know there's a 99.9% chance that you've either seen the high or low of the day. And if the day is far below the high, there's a 99.9% chance this will remain the high of the day. Only one chance in 1,000 or one chance in many thousand that the market is going to go all the way back up to a new high in the final bar of the day. However, that does not help you as a trader. Big deal. You know this is going to be the high of the day, but that's not going to affect your trading. However, knowing something about when a 90% chance of the high or low of the day has taken place is useful as a trader. And by the 18th bar of the day, there's a 90% chance that either the low of the first 18 bars will remain the low of the day, or the high of the first 18 bars will remain the high of the day. And that does help you as a trader. For example, if the market breaks below that 18 bar low, there's a 90% chance the market is not going above the high of the day. And that means there's a 90% chance that the day will either be a bear trend day or a trading range day. And the opposite is true if the market breaks above the 18 bar high. Then there's a 90% chance that the day will either be a bull trend day or a trading range day. And knowing that encourages you to buy pullbacks because you know that there's only a 10% chance the market's going to fall back below the low of the day. There's nothing magical about bar 18. The more bars that you look at, the higher the probability that you've seen the high or low of the day. So bar 23, it's better than a 90% chance that you've seen the high of the day or the low of the day if you get the breakout. Bar 16, it might be an 80% chance that if you break out of the 16 bar range, you've already seen the high or low of the day. But I like to use 18 because 90% chance is very, very high. And I want to know, did I see the high or low of the day? So I pay a lot of attention to what happens around bar 18. I want to talk about two types of breakouts on the open. And the first one I call breakout mode. And what I do is I look at the day at around the 10th bar of the day. I want to see if there's a reversal down from a new high. In other words, the market goes above the high of the first bar and reverses down. And I want it to go below the low of the day and reverse up. And that is a breakout mode situation. If it reverses up after reversing down, it can happen either way. It could reverse up and then down. The market's in breakout mode. and traders will look for some kind of a swing up if it breaks above the top of that range, or if it reverses up here and then breaks below, they'll look for a swing down. Here there's a bull breakout, and the breakout was strong. It's also around the breakout of the it's also around the breakout of the 18 bar range. And once you get that breakout, there's a 90% chance the day will either be a bull trend day or a trading range day. And you also look for around a measured move up, and the market went more than a measured move up based upon the height of this opening range. Again, this is bar 18, and we're breaking above the 18 bar range, and knowing that tells you that 90% chance this will remain the low of the day, and therefore if you buy, you can put a stop below that low. 90% chance it will not get hit. You'll either go up or you'll go sideways, and even if you go sideways, you can buy more lower, again putting your stop down here and having a high probability of making at least a scalp. This is not a breakout mode situation. We went below the low of the first bar, reversed up, we rallied and reversed down, but this high did not go above the high of the day. So this is not a classic breakout mode pattern. However, every day has 18 bars, and you look for a breakout below the 18 bar range or breakout above the range. And once you get that breakout below the range, 90% chance this will remain the high of the day, or excuse me, this will remain the high of the day. We pulled back a little bit and then we broke strongly to the downside. Odds are we'll get at least a measured move down or around a measured move down based upon the height of that 18 bar range. Bear breakout of that 18 bar range. So 90% chance you'll either get a swing down and a bear trend day, or it'll remain a trading range day. Here we had a swing down. The day became a reversal day. However, there was a good swing trade down. Again, as I said, this is not the classic breakout mode because this high did not reverse down from a new high of the day. I'm always paying attention to the high or low of the day, and it usually forms early, as I said. Again, this is a breakout mode pattern. After the first bar, we went above the first bar and reversed down, and then we went below the first bar and reversed up. As soon as the market reverses up, then we're in breakout mode. And theoretically, there are computers buying on a stop just above the high, and they will also place a stop to sell below the low. And if they get filled on the stop to go long up here, they'll place a protective stop on the low. Therefore, traders will buy on a stop above that high, expecting a measured move up. The bears tried to reverse down, they failed. The bulls tried to reverse up, and they're succeeding. And theoretically, the bears have their stop right above the top of this bear leg, and they'll give up. And that's why the bulls want to get long there. They know the bears are giving up. If the bears are giving up, they're probably not going to sell again for many, many bars. Again, look for a measured move once you get the breakout. Once you have the reversal down and then you're at a new low and the market's trying to reverse up, a lot of traders will buy the reversal up, taking a chance that we will get the breakout above the top of the range and the rally up. So you can often enter early. Here we have 3 consecutive inside bars. So it's an I. A lot of traders will buy above this bull bar, especially after this strong reversal up, front running the bulls who will buy the breakout to a new high of the day. And that's okay. First bar of the day, we broke below it, reversed up. We broke above it, reversed down. However, the pattern does not have many bars at this point. The reversal down took place on about the 6th bar or so. And to me, that's a less reliable breakout mode pattern. I want the trading range to last 10 bars or more. Once the market falls below that bear bar, then you have a reversal down, and theoretically, you're in breakout mode. except when the pattern is this small. A lot of traders wait for the pattern to grow and then look to see if there is a reversal down and a reversal up, and then they create their breakout mode pattern. So you can enter here, but the initial range where the reversals was small, and it's a less reliable breakout trade here. The market rallied and stalled at this minor lower high and formed a double top bear flag. And there's a second entry, micro double top. We went up and down and then up, and then we're turning down again. And we have a decent bear bar. And this is also a reasonable short, selling a pullback from the breakout to the new low of the day. Once you get the bear breakout, especially if you get that second bear breakout of a bigger opening range, 90% chance the market is going to be either in a bear trend day or a trading range day. And if it's in a trading range day, you can sell rallies, taking a chance that you'll get a bear breakout, knowing that the probability of the market going to a new high is only 10%. Again, when the initial range where the two reversals take place is small, only 6 bars, a lot of traders ignore the first reversal and they start counting with the second reversal and then look for a third reversal. So they might ignore this reversal up and then say this is the first reversal, and then they look for a new low of the day and a reversal up, and it creates a larger breakout mode pattern. And traders then will look to sell on a stop just below that low or buy on a stop just above that high. And then we get short there. Again, small pattern. First bar of the day, we went to a new low, reversed up, new high, reversed down. Only a 4-bar pattern. Traders are not going to be selling below the low or buying above the high on a stop. This is a limit order market. If anything, they'll be buying below bars and selling above bars, betting on reversals instead of breakouts. Traders will not trade breakout mode unless the pattern has more bars. And at this point now, 9 bars, it's around 10 bars, and it's more reliable to sell below here. It's still not a great breakout mode pattern. We have a lot of small bars, a lot of sideways bars with small bodies and big tails. It's a limit order market. Traders are selling above bars and scalping, buying below bars and scalping. It's more of a limit order market here. If they broke above the high, I think there probably are more sellers above. You have a 7-bar tight trading range filled with doji bars, bars with big tails, small bodies. It's a limit order market. Probably more traders selling with limit orders above that bar than buying with stops above that bar. And you can see it reverse down. And then the bull breakout failed. We got the bear breakout. After the first bar, we reversed up from a new low and now down from a new high. 9 bars instead of 10 bars. However, I think it's a higher probability trade after a bigger pattern than just trading after a 4-bar pattern. Again, when you have a tight trading range like this, buying with the stop at the top, selling with the stop at the bottom is usually not the best way to enter. It's better to wait to see if there's a strong breakout and then sell, or if there's a breakout and then a pullback and then sell. And your expectation will be less. If the market has a lot of early trading range price action and there is a breakout, the breakout is probably not going to go all that far. We have a breakout, big bear bar closing on its low, and a lot of traders will wait to see if the next bar is also a bear bar, at least has a small bear body, and then they'll sell that close. As soon as that bar closes, they'll hit sell in the market, or some traders will sell a second before it closes if they think the bar will have a bear body. Small range, about half of an average day's range, and therefore traders will